A business can be profitable on paper and still struggle to pay employees, suppliers, rent, and taxes. This usually happens because cash enters the business too slowly, leaves too quickly, or gets trapped in unpaid invoices, excess inventory, and unnecessary expenses. In this video, you'll learn 21 smart strategies to improve business cash flow without borrowing money. Number 1. Send invoices immediately. Many businesses complete a project on Monday, but wait until Friday, the end of the month, or even longer to send the invoice. That delay directly slows down cash flow. A customer cannot pay an invoice they have not received. Create a process where invoices are prepared and sent as soon as the product is delivered or the work is completed. For example, if your average invoice is $5,000 and you delay billing by 7 days, you are giving customers an extra week of free payment time. Use accounting software to generate invoices automatically. Confirm the correct billing contact before work begins, and attach all required documents. Faster invoicing does not require more sales. It simply brings existing revenue into the business sooner. Number 2. Collect deposits upfront. Collecting a deposit before beginning work is one of the most effective ways to improve cash flow without borrowing. A deposit helps cover materials, labor, equipment, and other costs required to complete the job. For example, imagine a contractor accepts a $20,000 project that requires $6,000 in materials. Without a deposit, the contractor must finance those materials personally. With a 40% deposit, the business receives $8,000 before work begins. This protects cash flow and reduces the financial risk of customer cancellations. Clearly explain your deposit policy in every proposal and contract. Customers are more likely to accept upfront payments when the amount is reasonable, the deliverables are clearly defined, and the payment schedule is communicated before the agreement is signed. Number 3. Shorten payment terms. Payment terms have a major effect on how quickly revenue becomes usable cash. If you currently offer customers 60 days to pay, consider changing the standard term to 30 days, 15 days, or payment upon receipt. This does not mean treating customers unfairly. It means matching payment terms with the financial needs of your business. A company billing $100,000 per month could have $200,000 tied up in receivables under 60-day terms. Reducing that collection period to 30 days could release a significant amount of cash. Review each customer instead of using the same terms for everyone. Reliable customers may receive flexible terms, while new or slow-paying customers should receive shorter terms. Always place the payment deadline clearly on the invoice and contract. Number 4. Follow up before due dates. Most owners contact customers only after an invoice becomes overdue. A better approach is to follow up before the payment deadline. Send a friendly reminder 5 to 7 days before the invoice is due, confirm that the invoice was received, and ask whether any documents or approvals are missing. Many delayed payments happen because an invoice was sent to the wrong person, a purchase order was missing, or the customer had a question that nobody answered. A simple reminder can prevent those delays. Create an automatic schedule for invoice confirmations, upcoming due reminders, overdue notices, and personal follow-ups. Keep the communication professional and consistent. Your objective is not to pressure good customers. It is to remove payment obstacles before they turn into serious cash flow problems for your business. Number 5. Offer smart early payment discounts. A small early payment discount can encourage customers to pay faster, but it must be used carefully. For example, you might offer a 1% discount when an invoice is paid within 10 days instead of 30 days. On a $10,000 invoice, the customer saves $100, while your business receives $9,900 20 days earlier. That may be worthwhile when faster cash allows you to pay suppliers, accept another project, or avoid expensive late charges, However, do not offer large discounts that destroy your profit margin. Calculate the actual value of receiving the money sooner. Offer the discount only to customers who normally use the full payment period. Customers who already pay early do not need an additional incentive to continue doing what they already do. Number 6. Move customers to automatic payments. Automatic payments reduce the time spent waiting, reminding customers, and processing transactions. This strategy works especially well for monthly services, maintenance agreements, memberships, software, consulting, and other recurring offers. Instead of sending an invoice every month and hoping the customer remembers to pay, securely collect payment information and charge the agreed amount on a scheduled date. For example, a service company with 50 clients paying $500 per month generates $25,000 in recurring revenue. If 10 clients regularly pay late, thousands of dollars may remain unavailable each month. Automatic billing makes cash inflows more predictable. Always obtain written authorization, explain cancellation rules, and notify customers before major charges. Predictable collections help the business plan payroll, supplier payments, marketing, and operating expenses with greater confidence. Number 7. Use milestone billing. Waiting until a large project is completely finished can create severe cash flow pressure. Milestone billing divides the project into smaller stages, with payment required when each stage is completed. A $50,000 project might include a 20% deposit, 30% after design approval, 30% after implementation, and 20% after final delivery. This structure keeps cash entering the business while expenses are being incurred. It also prevents the company from completing months of work before receiving payment. Each milestone should have a clear deliverable, deadline, payment amount, and approval process. Do not begin the next major stage until the previous payment has been received. Milestone billing is not only good for cash flow, it also creates accountability and reduces disagreements about progress, scope, and customer expectations. Number 8. Raise prices where value supports it. Improving cash flow does not always require finding more customers. Sometimes the fastest solution is charging the correct price for the value you already provide. Suppose a business completes 100 jobs per month at $200 each, producing $20,000 in revenue. A 10% price increase would add $2,000 per month before considering any additional sales. Review prices for services that have become more expensive to deliver, require specialized expertise, or create strong customer results. Do not increase every price without analysis. Examine competitors, customer demand, delivery costs, and profit margins. Communicate price changes clearly and provide enough notice. A thoughtful price increase can strengthen cash flow, protect service quality, and reduce the pressure to accept every low-value customer just to keep money entering the business. Number 9. Stop low-margin work. Revenue can look impressive while producing very little cash. A project that brings in $10,000 but costs $9,500 to complete contributes only $500 before overhead and taxes. Low-margin work consumes labor, materials, management, attention, and working capital that could be used for better opportunities. Calculate the gross profit and cash requirements of every major product, service, customer, and project type. Identify work that regularly creates delays, revisions, overtime, refunds, or high material costs. Then increase the price, redesign the offer, reduce the delivery cost, or stop selling it. The goal is not to eliminate every lower-priced offer. The goal is to stop confusing revenue with financial strength. Cash flow improves when the business focuses on work that generates meaningful cash after direct costs. Number 10. Sell more to existing customers. Acquiring a new customer often requires advertising, sales calls, proposals, follow-ups, and discounts. Existing customers already understand your business and may be easier to serve again. Review what your current customers are buying and identify logical additional products or services that solve related problems. An accounting firm might add payroll support. A cleaning company might offer quarterly deep cleaning. A software provider might offer training or premium support. The offer should create genuine value rather than feeling like an unnecessary sales push. Contact satisfied customers at the right time, explain the additional result they can receive, and make the purchasing process simple. Increasing revenue from existing relationships can improve cash flow faster because customer acquisition costs are lower and trust has already been established through previous work. Number 11. Create recurring revenue. One-time sales create unpredictable cash flow because the business must repeatedly find new customers to replace completed transactions. Recurring revenue creates a more stable financial foundation. Look for services customers need regularly, such as maintenance, reporting, consulting, support, delivery, training, inspections, or access to specialized resources. A company that sells a $2,000 service once may earn that amount only one time. Converting part of the service into a $200 monthly plan could generate $2,400 over a year while giving the customer continued support. The recurring offer must provide ongoing value and clear deliverables. Avoid creating subscriptions that customers do not understand or use. Well-designed recurring revenue improves cash flow forecasting and reduces the financial uncertainty created by constantly starting each month with zero committed sales. Number 12. Reduce excess inventory. Inventory may appear as an asset on the balance sheet, but it represents cash that cannot be used until the product is sold. Excess inventory creates storage costs, damage risk, insurance expenses, and the possibility that products become outdated. Review inventory by sales speed, margin, age, and customer demand. Identify products that have not sold within the expected period. Discount slow-moving items. Combine them with popular products. Return eligible stock to suppliers, or sell them through alternative channels. Then use the recovered cash for products that sell faster. Avoid purchasing large quantities only because the supplier offers a lower unit price. Saving 5% on inventory is not helpful when the business must wait 12 months to recover the cash. Inventory decisions should support cash flow, not just purchasing discounts. Number 13. Buy inventory closer to demand. After reducing excess inventory, improve the purchasing system so the same problem does not return. Use past sales data, seasonal patterns, confirmed orders, and customer demand to decide when and how much to purchase. Smaller and more frequent orders may have a slightly higher unit cost, but they can protect cash by reducing the amount tied up in storage. For example, buying $30,000 of inventory every quarter requires a large cash payment at one time. Purchasing $10,000 monthly may better match actual sales. Establish reorder points for important products and minimum stock levels for items that sell consistently. Do not rely only on instinct or supplier pressure. The objective is to have enough inventory to serve customers without turning the warehouse into a collection of money that cannot be spent. Number 14. Negotiate better supplier terms. Supplier negotiations can improve cash flow without reducing the quality of products or services. Ask whether suppliers can offer 30-day payment terms, smaller deposits, scheduled deliveries, volume-based pricing, or split payments. For example, paying a supplier on delivery may require $20,000 immediately. Receiving 30-day terms allows the business to sell some of the inventory and collect customer payments before the supplier invoice becomes due. Approach the conversation professionally. Suppliers are more likely to offer better terms when you pay reliably, communicate clearly, and place consistent orders. Do not demand longer terms while repeatedly paying late. You can also compare quotes from alternative suppliers to understand whether your current pricing and conditions remain competitive. Better supplier terms create breathing room by improving the timing between cash leaving and cash returning. Number 15. Match payments with collections. Cash flow problems often happen because expenses are due before customer payments arrive. Review the timing of rent, payroll, software, supplier bills, taxes, and customer collections. Then adjust payment dates where possible. For example, if most customer payments arrive between the 15th and 20th of the month, scheduling major supplier payments on the 1st may create an unnecessary cash shortage. Ask vendors whether due dates can be moved closer to your collection cycle. You can also divide large annual payments into monthly or quarterly installments when the total cost remains reasonable. This does not mean paying bills late or damaging relationships. It means organizing payment timing intelligently. A business may earn enough money over the month but still struggle during specific weeks because cash inflows and outflows are poorly coordinated. Number 16. Cut expenses that produce no return. Across-the-board cost-cutting can harm customer service and future growth. Instead, remove expenses that do not produce a clear financial or operational benefit. Review every subscription, software tool, professional service, advertising campaign, membership, and recurring charge. Ask whether it increases revenue, reduces costs, saves meaningful time, improves customer retention, or lowers risk. A company may discover that it is paying $800 per month for software used by only 2 employees. Canceling or replacing that tool could preserve $9,600 per year. Small recurring expenses deserve attention because they quietly reduce cash every month. Do not cut essential activities simply because they are expensive. Focus on waste, duplication, unused services, and purchases made from habit rather than measurable business need. Number 17. Improve labor scheduling. Labor is one of the largest cash expenses for many businesses. Poor scheduling creates unnecessary overtime, idle time, rushed work, and low productivity. Review customer demand by day, hour, season, and project stage. Schedule the right number of employees based on actual workload instead of using the same staffing level every day. A restaurant may need more employees during weekend evenings, but fewer during weekday afternoons. A service company may group jobs by location to reduce travel time and fuel costs. Improving scheduling does not mean overworking employees or reducing service quality. It means removing avoidable inefficiency. Track revenue per labor hour, overtime costs, rework, missed appointments, and unbillable time. Better labor planning allows the business to complete more valuable work without increasing payroll at the same rate. Number 18. Sell unused business assets. Unused equipment, vehicles, furniture, tools, electronics, and materials contain cash that the business cannot currently use. Walk through your office, warehouse, workshop, and storage areas to identify assets that have not supported operations for several months. A machine purchased for a discontinued service may still have resale value. An extra vehicle may be creating insurance and maintenance costs without generating revenue. Sell these items through industry marketplaces, local dealers, auctions, or direct business networks. Before selling, confirm that the asset is not essential for upcoming work and review any tax consequences with a qualified professional. Selling idle assets provides a one-time cash injection without debt. It can also reduce storage, insurance, repair, and maintenance expenses, improving both immediate and future cash flow. Number 19. Set minimum order values. Small orders can consume almost as much administrative time, delivery cost, packaging, customer support, and payment processing as larger orders. Establishing a minimum order value helps protect the cash generated from each transaction. For example, delivering a $20 order may cost $12 in labor, fuel, packaging, and transaction fees. The sale produces revenue, but contributes very little cash. A $75 minimum order could make each delivery more financially worthwhile. Service businesses can use minimum project fees, minimum consultation times, or minimum monthly commitments. Explain the policy clearly and provide alternatives such as customer pickup or combined orders. Minimum order values should reflect your actual cost structure, not an arbitrary amount. The objective is to ensure every accepted transaction contributes enough cash to justify the resources required to complete it. Number 20. Pre-sell new offers. Pre-selling allows a business to collect cash before spending heavily on production, inventory, or delivery. This works well for training programs, events, product launches, limited editions, consulting packages, and seasonal services. Present the offer to a small group of qualified customers. Explain what they will receive, state the delivery date, and provide an early purchase benefit. The customer might receive a better price, priority access, or an additional feature. The business receives cash and confirms real demand before making a major investment. Never pre-sell an offer you are uncertain you can deliver. Be transparent about timelines, refund policies, limitations, and product details. A successful pre-sale reduces financial risk because customer demand helps fund the work instead of the owner spending cash based only on assumptions. Number 21. Review cash flow every week. Cash flow improves when it becomes part of the weekly management routine rather than an emergency reviewed only when the bank balance is low. Create a simple 13-week cash flow forecast showing expected customer payments, payroll, supplier bills, taxes, rent, and other major expenses. Update it every week using the latest information. Compare expected cash with actual cash and investigate major differences. If a large invoice is delayed, you can follow up immediately. If an expensive purchase is approaching, you can reschedule it before it creates a shortage. Include upcoming tax payments, annual renewals, seasonal changes, and equipment needs. A weekly cash flow routine gives the owner time to act. Without it, the business discovers problems after the cash has already disappeared. Good cash flow management is built through visibility, discipline, and timely decisions. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.